If AI can predict markets better than humans, who do you think it's really working for? Let me ask you something. What if the single biggest threat to your retirement isn't inflation, isn't a housing crash, isn't even a recession in the traditional sense, but something that most retirement planning advice hasn't even begun to account for? What if the thing quietly dismantling decades of conventional financial wisdom is the same technology being celebrated on every business channel, every earnings call, every tech headline right now? We're going to talk about AI today, but not in the way you're used to hearing about it. Not hype, not doom, something more useful than either of those. We're going to talk about your 401k and why, if you're over 40, the math inside it may be quietly working against you. Meet Robert. He's 57. He lives outside Columbus, Ohio. He makes about $91,000 a year before taxes, solid middle class by most measures. After federal and state taxes, he takes home roughly $68,000 annually, about $5,650 a month. His mortgage is $1,480. His car payment is $410. He's still carrying about $14,000 in credit card debt from a rough patch a few years ago. That's another $280 a month minimum. Groceries, utilities, insurance, call it another $900. His daughter's college contributions, $300 a month. That leaves him in a best-case month with maybe $800 to $1,000 of actual breathing room. Not a lot. But Robert has done one thing right, mostly by inertia. He has been contributing to his 401k since 1998. He has about $480,000 in it. He chose his allocation once, sometime around 2014, and hasn't touched it since. 60% stocks, 40% bonds. Standard. Conservative even, or at least it used to be. Here's what Robert doesn't know. Because he said it and forgot it, and because the stock market has had an extraordinary decade, his portfolio is no longer 60-40. It's closer to 84% stocks, 16% bonds. He didn't make a single aggressive move. The market just ran. And now, without doing anything, Robert is carrying the risk profile of someone 20 years younger, right at the moment in his life when he can least afford a major loss. Robert is not unusual. He is, statistically, the median. Let's pause on that drift from 60-40 to 84-16, because it matters enormously, and very few people have bothered to explain why. In simple terms, stocks grow faster than bonds. Over the past decade, U.S. stocks returned something in the range of 12 to 14% per year on average. Bonds returned maybe 2 to 4%. So a portfolio that was equally split in percentage terms gradually becomes unequally split. The stocks take up more and more of the pie. Vanguard, one of the largest 401k administrators in the country, actually published data on this. In their December 2024 survey, they found that among savers over 55 who manage their own allocations, meaning they're not in a target date fund, they're picking their own mix, roughly half had more than 70% of their money in equities. In 2024, stocks returned about 17%. Bonds returned about 7%, so that gap just got wider. Now, if you're 30, that drift isn't particularly dangerous. You have time. If the market drops 40%, you wait. You keep contributing. It recovers. History says so. But if you're 57 like Robert, or 61 or 63, and you're planning to retire in the next 5 to 8 years, a 40% stock market crash doesn't give you a recovery window. It gives you a crisis. It means you either delay retirement, work longer than your body may allow, or withdraw money at exactly the wrong moment, locking in those losses permanently. The technical term for that is sequence of returns risk. The practical term is your retirement gets cut in half right when you needed it most. Now, stock market crashes have happened before. The dot-com bust, the 2008 financial crisis, COVID. Markets recovered from all of them. So why is this moment different? Why bring AI into a retirement conversation at all? Because this time, the stakes sitting on top of the market are of a scale that warrants some honest attention. Amazon, Meta, Alphabet, Microsoft, and Oracle are together planning to spend $700 billion on AI infrastructure in 2025 alone. That is not a typo. $700 billion in a single year. That spending is already baked into stock valuations. Investors are pricing in a future where this capital creates enormous, sustained returns. And that optimism has pushed valuations to levels that are historically extraordinary. The S&P 500 is currently trading at roughly 28 times forward earnings. The historical average across an entire century is closer to 14 times. That means, by one reasonable measure, the market is priced at double its historical norm. If a company's stock trades at $100 and it earns $7 per share, the earnings yield is 7%. That's historically where stock returns have come from, not just speculation, but the underlying earnings power of companies. A PE of 14 gives you a 7% earnings yield. At a PE of 28, that earnings yield drops to about 3.5%. Now, 3.5% is still better than a typical savings account, but it's barely better than what Treasury bonds offer right now. And unlike bonds, stocks can fall 30, 40, 50% in a bad year. So the question becomes, are you being compensated enough for that risk? At today's valuations, a straightforward reading of the math says probably not. And then you add the AI variable. The optimistic scenario, assigned roughly 40% probability by economists in Moody's, is that AI boosts productivity, keeps profits growing, and leads to broad prosperity. That would justify elevated valuations. But the pessimistic scenario, which Moody's assigns about 25%, is AI disappoints, that the $700 billion in investment doesn't generate the expected returns, that tech companies' revenues fall short of projections, that stock prices drop and consumer spending contracts with them. There's also a third scenario that Moody's puts at 20%. AI succeeds technologically but causes enough job displacement that a significant portion of the workforce is worse off. White-collar jobs in insurance, finance, customer service, legal research, real estate, roles that involve processing information and mediating between systems get automated faster than new roles emerge to replace them. Unemployment rises, spending falls, mortgages go unpaid. This isn't the plot of a science fiction film. Adobe is already down more than 40% over the last year. Salesforce, similar territory. Block is cutting 4,000 jobs. The disruption isn't hypothetical. It has already started in parts of the software sector. None of this is certain, but the point of risk management is never certainty. The point is when there are multiple plausible bad outcomes with meaningful probabilities, a rational person adjusts. So why hasn't Robert adjusted? Why haven't most people in his situation? There are a few clean psychological explanations. The first is recency bias. For over a decade, stocks have mostly gone up. Every dip recovered. Every warning turned out to be wrong. The brain learns from patterns, and the pattern it has learned is stocks go up. Fear is for suckers. Adjusting feels like flinching. The second is inertia dressed up as strategy. Many people don't change their allocations not because they've thought it through, but because they haven't thought about it at all. Doing nothing feels neutral. It doesn't feel like a decision, but financially, it is one. The third is what behavioral economists sometimes call loss aversion asymmetry. Selling stocks that have performed well feels like giving something up, even if you're simply rebalancing. You watch your stock position go from $480,000 to $410,000 after rebalancing, and it feels like a loss, even though you still have $410,000 in equities, plus $70,000 in something more stable. And the fourth is what you might call complexity avoidance. TIPS, Treasury inflation-protected securities, are not a household term. Rebalancing sounds complicated. People put off decisions that feel technical. Meanwhile, the financial industry benefits from that passivity. Higher equity exposure means more volatility, more trading, more fees. Robert, like most people, hasn't done anything wrong in the conventional sense. He saved consistently. He invested. He didn't panic sell in 2020. He did most of what personal finance books tell you to do. But there's a gap between doing the basics correctly and actively managing risk as your life circumstances change. Here's what someone who thinks about this clearly does differently. Not dramatically, not cleverly, just differently. They separate growth from protection. At 35, a portfolio's job is growth. At 57, a portfolio's job is a mix. Some growth, yes, but also capital preservation. The goal shifts, and the allocation should reflect that shift. even if the market hasn't given you a reason to be cautious yet. They rebalance on a schedule, not because the market told them to, but because their life stage demands it. Once a year, or after a major life event, they look at what percentage of their portfolio is in stocks versus bonds, or inflation-protected securities, and they bring it back to a target that reflects their actual risk tolerance, not the risk tolerance of a 35-year-old. They understand what TIPS are and why they matter right now. TIPS, Treasury Inflation-Protected Securities, are bonds issued by the U.S. government that adjust with inflation. If inflation goes up, so does the value of the bond. The principal is protected. Right now, TIPS in the 5 to 30-year range are yielding about 1.5% to 1.9% in real terms, meaning above and beyond inflation. That's not exciting, but for someone who needs their money to survive a potential 30% market correction in the next 5 years, not exciting is exactly the point. You're not trying to win, you're trying to not lose. The Schwab TIPS ETF, for reference, charges 0.03% annually. Vanguard and Fidelity have similar funds at 0.05%. These are among the cheapest financial instruments available to retail investors. If your 401k provider doesn't offer access to low-cost index funds or TIPS funds, that is worth addressing, either by lobbying your HR department or, if you have a self-directed IRA, building the position there directly. If you have an IRA with over $100,000 available, one approach worth knowing about: buying individual TIPS in roughly equal amounts maturing at 5, 10, 20, and 30 years. That ladders your maturities and gives you an average real yield in the neighborhood of 1.9% with the government's backing. None of this is glamorous. It doesn't beat the market. It's not supposed to. It's supposed to make sure that a major market event, which, given current valuations and the AI uncertainty, carries higher than average probability, doesn't destroy what you spent 30 years building. Back to Robert. He doesn't need to panic. He doesn't need to move everything out of stocks. He doesn't need to predict what AI does to the economy. What he probably needs to do is have an honest conversation with himself about what 84% equity exposure actually means for his specific life situation. He retires in roughly 8 years if everything goes to plan. He doesn't have a pension. His Social Security estimate is around $2,100 a month. His mortgage will be paid off in 11 years, slightly after his planned retirement date. He has no real safety net beyond the 401k. If the market drops 40% the year before he retires, he doesn't retire at 65. He works until 68, 69. Or he retires and pulls from a depleted account, which compounds the problem year after year through what's called the withdrawal rate problem. A more rational target for Robert, given his timeline, might be something like 60% stocks, 40% TIPS or bonds. Not because he's afraid, but because the expected return difference between 84% stocks and 60% stocks does not justify the additional downside risk given where valuations are today. That's not fear-based thinking. That's just arithmetic. AI is neither a guaranteed revolution nor a guaranteed disaster. It is a genuine source of elevated economic uncertainty, arriving at the same moment that stock valuations are already stretched thin, and a large number of Americans in their late 50s are unknowingly sitting on portfolios far riskier than they realize. The combination of those three things, AI uncertainty, high valuations, and portfolio drift, is not alarmist. It's just the current environment, and it deserves to be taken seriously, calmly, and without theater. The people who tend to come out of volatile periods in decent shape are not the ones who predicted everything. They're the ones who looked at their situation honestly, acknowledged what they didn't know, and adjusted their exposure to reflect that uncertainty before the uncertainty resolved. You don't have to act on any of this today, but it's worth looking at your allocation number. Just that. Go log into your account and see what percentage is in equities right now. If the number surprises you, that's useful information. That's it. Take care of yourself. Subscribe.